Great. So the question reads, Maya Limited produces two products, namely product M and product Y. The following budget applies for the year ended 30th June 2024. We have selling price, variable costs, contribution margin. Then we have fixed costs. Units sold is also given down there, right? So the unit sold is given in bags. Fixed cost is given per annum, right? So we are not given fixed cost per unit. We are not given fixed cost per unit. Good. So under required, number one, the break-even point at current sales mix. Two, break-even point at proposed sales mix of 1:1. Current margin of safety. Then sales units required to earn a profit of 299 million at current sales mix. Good. So when you talk about break-even point analysis, when you talk about break-even point analysis with the multiple products, the only thing that will be affected is the denominator. The only thing that will be affected is the denominator. And why is it that our denominator will be affected? Remember, we are going to deal with two different products, 3 or even 4 different products whose selling price per unit is not the same. And therefore, we will not have the same contribution per unit. We will not have the same contribution margin. And therefore, we have to make sure that as we get the break-even point in units, we get the cumulative, the average, the cumulative average of these 3, 4, or even 5 products. So how do we deal with that first part? I will now write down the formulas that will be applying when dealing with what we call multiple products. Multiple products, right? So when you're dealing with multiple products, break-even point in units, first of all, we must talk about total fixed cost divided by summation of weighted average contribution margin. So how do we get this weighted average? Weighted average contribution margin is equal to sales mix is equal to sales mix, or we can put so summation of weighted average contribution margin is equal to summation of sales mix of product A multiplied by contribution margin of A plus sales mix of product B multiplied by contribution margin of product B. Contribution margin of product B. So if I have the third product, that's what I will be talking about. That is what I will be talking about. Good. Then, how do we get the sales mix ratio? Right? So another name of sales mix is the same as, we call it alpha, right? So how do we get sales mix ratio? It is the quantity. It is the quantity of product A divided by quantity of A plus quantity of product B. That will give us the sales mix ratio of product A. So that is sales mix ratio of product A. If I want sales mix ratio of product B, it is the quantity. So sales mix ratio of product B, that is now alpha of B, is equal to quantity of B divided by quantity of A plus quantity of B. So that will give us the sales. That will give us the sales mix ratio. sales mix ratio. Good. Fibs, are you able to see what I've indicated on the board? Are you able to see what I've indicated on the board? Good. So that is the standard formula. If we have another formula that will help us get the same thing, well and good, we'll be able to also explore that and see whether we'll be getting to the same point. But the standard one we are going to use for this session is given in this manner. Good. So once I have this, I'll be able to get break-even point in what? In units. I'll be able to get break-even point in units. And being that I'm dealing with 2 or 3 different products, yes, that is the formula. That is the formula. That is the formula. That is the formula. Good. So being that I'm dealing with 2 or 3 different products with different selling prices, then what are we going to do? What we'll be doing is very simple. We now talk about break-even point for each product. So break-even point in shillings will be equal to break-even point in units multiplied by selling price. Multiplied by selling price per unit. Multiplied by selling price per unit. Good. Sales mix ratio of A, contribution margin of A. Oh, thank you for that. Sales mix ratio of B, contribution margin of B. Oh, thank you for that. Thank you for that. Good. So having done that, can we now go ahead and have our break-even point in units for the multiple products? So of course, we need to get our contribution margin is appearing somewhere, right? Contribution margin. And we all know how we are getting contribution margin when you're dealing with single products. So contribution margin is equal to selling price minus variable cost. Margin of safety, don't forget that, is equal to expected sales minus break-even point. So it can be in shillings or in units. It is not changing anytime soon. Our total fixed cost is still the total fixed cost. So maybe I want to create some space here. Plus sales mix of A times contribution of B, yeah. So that I have some adequate space here. So let's look at, sorry, we are not able to see below. Margin of safety, is it visible? Expected sales minus break-even point. Expected sales minus break-even point. Is it visible? Yes, it should be. Good. So let's now collect these items. In our formula, we have total fixed cost, or let's start with we have product M, we have product Y. So let's start with the selling price. Let's start with the selling price. Break-even point in shillings is equal to break-even point in units multiplied by selling price. Contribution margin is equal to selling price per unit minus variable cost per unit. Then margin of safety, expected sales minus break-even point. Minus break-even point. Minus break-even point. Great. So are we given selling price? Selling price for product M is 6, that is per unit of M. Then we have 12 here. We have 2. we have 4. That is a variable cost. Then to that, we'll be having what we call contribution. Contribution margin. So contribution margin, this will be 4. This will be, yes, selling price is 6. Good. So having done that, we have our contribution margin. What did we say about weighted or summation of weighted average contribution margin is equal to sales mix ratio multiplied by contribution margin. So we already have our contribution margin. The only thing that is missing is the sales mix ratio. So let's look at sales mix, or we call it alpha. We call it alpha. So how do we get alpha? We have said that sales mix ratio is the quantity of B, the expected sales of B, divided by the total expected sales in units, right? So let's start with our first product. Our first product is product M. What is the expected sales in terms of units? Expected sales in terms of units for product M. Expected sales or units sold for product M. Tuko na ngapi? 70 million, right? Then product Y. Product Y, what is the expected sales? 30 million, right? Can we get the total of these two? What is the total of the two? 100 million. So in terms of proportion, what proportion of this total is taken by product M? We divide by the total number of units. 100. We divide by the total number of units. So what do we have as the sales mix ratio for product M? M ni 0.7 and Y is 0.3. Mtu amepata 0.2 somewhere. 0.7, 0.3. So this will be 0.7. This will be 0.3. So let's go ahead and get what we call weighted average contribution margin. So weighted average contribution margin, if I remove the element of summation, then of course I'll be having contribution margin times sales mix ratio. So what do we have for product M? What do we have for product M? 2.8. Product Y? Product Y? 2.4. Good. Can we now bring in the summation element? So summation of weighted average contribution margin will be equal to 2.8 plus 2.4. 2.8 plus 2.4. That is 5.2. So what are we lacking in our formula? For us to be able to get break-even point in units, we now need total fixed cost. Do we have total fixed cost? Total fixed cost. We are given fixed cost per product. So we have to bring all of them together. 96,400 plus 200 What is your total fixed costs? What is your total fixed costs? Total fixed cost ni ngapi? 96,400,000 plus 200 million. 200 million or 296? $400,000. Good. So having done that, are we able to get now our break-even point in units? Break-even point in units will be total fixed cost divided by contribution margin or weighted average contribution margin ratio. What is our break-even point? Weighted average contribution margin is sales mix ratio of the first product multiplied by its contribution plus sales mix ratio of the second product multiplied by its contribution margin. So do we have sales mix ratio? Yes, 0.7. How about its contribution margin? Set 4. So 4 by 0.7 should give us 2.8. 0.3 by 8 should give us 2.4. When I add the 2, I'm now bringing in the element of summation. 2.8 plus 2.4, giving us 5.2. That's how we got the figures. Is it clear, Evelyn? Is it clear, Evelyn? Great. So now let's come to this part. Our break-even point in units is 57 what? 57 million. 57 million bags. That's our break-even point in. That's our break-even point in units. Are we able to know the exact quantity for M and exact quantity for Y? Are we able to know that? And I want us to go ahead and compare. Will it give us a profit of 0? Let's compare. So how do we now get the number of units for product M and the number of units for product Y, right? So the break-even point in units for individual products will be done based on the sales mix ratio. This product M has got a share of 0.7. Then this product Y has got a share of 0.3. So can we take for product M, it will be 0.7 multiplied by 57 million. Then product Y, it will be 0.3 times 57 million. So what are we getting? For product M, how many bags do we have for product M? How many bags do we have for product M? 39,900,000 bags. Product Y? Product Y? 0.3, that is 17 million. $17,100,000 bags. 17,100,000 bags. So that is what we have. And of course, you can see when you add the two, it must give you what they are sharing here. It is bags or shillings. Break-even point in units. Break-even point in units. It is in bags. It is in bags. We are going to get our break-even point in what? In shillings. So if you are told to give us the break-even point in shillings, what do we need to do? We now go ahead and get the number of units that will give us break-even point. We multiply by the selling price per unit. So for us to get break-even point in shillings, now in shillings for product M, we will be talking about 39,900,000. We multiply by 6 shillings. Then product Y, we have 1,700,000 bags. We multiply by 12 shillings per bag. So what is our break-even point in shillings? For product M, what will be our break-even point in shillings for product M? 39,900,000 we multiply by 6. What are we getting? 239,400,000. 239,400,000. Good. How about product Y? 20 million or 205 million, 200,000. 205 million. 205 million, 200,000. 205 million, 200,000. 205 million, 200,000. So that's what you're supposed to. That's how you're supposed to do your calculations for the break-even point in units. Now, when dealing with multiple products, we have said the selling price is not the same. Contribution margin will not be the same. And that's why we have to get the break-even point in units first. And once we have the break-even point in units, we now use the sales mix ratio to distribute these units to the individual products. That's why we took the sales mix ratio of 0.7 by 57 million to give us the quantity of product M at break-even point. That is why we use the sales mix ratio of 0.3 for product Y to give us the break-even point of 1,700,000 bags of product Y. How do we get break-even point in shillings? We must get the break-even point in units for individual product, then multiply by its own selling price. That is why we took 39,900,000 multiplied by 6 to give us break-even point in shillings. That is why we took 17,100,000 multiplied by 12 to give us the break-even point in what? In shillings for product Y. So that's how we get our break-even point in shillings and in units for multiple products. So I want us to use this break-even point and see whether we'll be able to do what? To break even. Good. CN, do you have 2.8 and 2.4? CN, do you have 2.8 and 2.4? Good. So when you take 2.8 plus 2.4, what are you getting? 2.8 plus 2.4 is giving us 5.2. So is your question answered? Is your question answered? CN confirm. Is your question answered? CN. CN confirm. Is your question answered? Okay. Means it disappeared. So that is beyond us. So let's go to maybe confirmation. Can we confirm that this break-even point in units and shillings will give us a break-even point or net profit of 0? So can we get revenue at break-even point? So revenue at break-even point, we'll be talking about the units at break-even point. We have 39,900,000. We multiply by selling price, which is 6, plus 1,700,000. We multiply by 12, right? So this will give us total revenue. Then to that revenue, we need to less cost of sales or variable cost. We need to less variable cost. So variable cost variable cost will be 39,900,000 multiplied by 6 plus 17,100,000 multiplied by not 6 but by variable cost per unit by 2. Then this one here we multiply by 4, right? So this of course will be deducting. So what are you getting as your revenue? What are you getting as your revenue? I want us to confirm that will this break-even point give us a net profit of 0? The only mistake we normally do, we focus on the questions that you are required to answer than listening to the concept. I'll come back to the question later. Let's focus on the concept. Let's focus on the concept. So what is your total revenue? 444,600,000. How about variable cost? How about variable cost? How about variable cost? 148,200,000. Good. So when I deduct that, you'll get what you call gross contribution. Gross contribution. So what are you getting? Gross contribution, revenue minus variable cost. What is your gross contribution? 296,400. 296,400, then we less fixed costs. What was our total fixed cost? 296,400. What is your net profit at break-even point? What should be our net profit at break-even point? What should be our net profit at break-even point? It should be a 0. It should be a 0. So is it true that what we have here is correct? Is it true that what we have done here is correct? Yes. So we now confirmed that is actually taking us to a net profit of what? Of 0. Can we now go ahead and get margin of safety? Can we now go ahead and get what we call margin of safety? So margin of safety is equal to expected sales minus break-even point. It can be in units, it can be in shillings. So let's start with maybe margin of safety in units. So our margin of safety here in units, expected sales in units we are having, we add 70,000 units plus 30,000 units, that was 100,000. 100,000. 100 million units, right? Minus break-even point in units, we are talking about 57 million. 57 million. Remember, they are bags. These are bags. Good. So what is our margin of safety in units? Our margin of safety in units, 43 million. 43 million. 43 million bags. Good. How about margin of safety in shillings? Our margin of safety in shillings is equal to expected sales, right? Is equal to expected sales. Can we get the expected sales? Yes. The expected sales was 70,000 units. Was it 70,000 or 70 million? 70 million, 70 million, 70 million bags of A whose selling price is 600 or 6 shillings plus 30 million, and each was going for 12 shillings. What was our total expected sales in shillings? Total expected sales in shillings? Total expected sales in shillings? Tulikuwa na ngapi? It should be 70 million. It should be 70 million. $780. So this is 780 million. That is expected sales minus break-even point in shillings. Are we able to get our break-even point in shillings? Yes. For product M, it is 239,400. For product Y, it is 205,200. So when you add the two, what are you getting as the total break-even point? Triple four, 600,000. Triple four, 600. So this one is in bags. This one will be in shillings. So what's our margin of safety in shillings? What is our margin of safety in shillings? What is our margin of safety in shillings? The difference between the two should be our margin of safety in shillings. 335, 400,000. 400,000. Good. So that's what we have in shillings, our margin of safety. Are we able to express this as a percentage? Or maybe you have your margin of safety in units. Can we now divide for each product? For each product, don't forget about the ratio. You will use that ratio to distribute what? To distribute this number of bags to product M and to product Y, right? For example, if I were to take this for each product, M will be having 0.7 of 43 million. Someone should be having the answer already. Then product Y will be having 0.3 times 43 million. What share will be taken by product M? What share will be taken by product M? Margin of safety for each product, 30 million, 100,000. So this will be 30 million, 100,000. How about Y? How about Y? 0.3 of 43 million. 0.3 of 43 million. Itakuwa ngapi? 12,900,000. 12,900,000. So those are bags. Bags. Margin of safety in what? Margin of safety in units. What if I were to get it in shillings? I'll be taking this, multiplying by 6 shillings. I'll be taking this one, multiply by 12 shillings. Great. But I want us to go back again, having looked at that, still under margin of safety. Can we get our margin of safety as a percentage and compare the two, whether they will give us the same thing? So margin of safety in units, right? In units. This one is in shillings, right? So in units, margin of safety as a percentage will be margin of safety over expected sales. Then all of that you express as a percentage, right? So let's start with margin of safety in units. That will be 43 million. 43 million. We divide by the total number of bags or expected sales of 100 million, then we express as a percentage. Then We can also get it by use of the margin of safety in shillings. That is, so we can talk about or 33,335, 400,000 divide by 780 million. The whole of this we express as a percentage. So what are you getting for the first one? 3 decimal places. Expected sales, we are not calculating anything. Expected sales is given to us. Can we go back to the table and confirm that the figure is there or not? Maya Limited produces 2 products, namely product M and product Y. The following budget applies for the year ended 30th June 2024. In a question of this nature, if I have the term budget is the same as expected, is the same as the standard sales budget. Now, the selling price is 6 shillings for M, 12 shillings for Y, variable cost 24, contribution 4 shillings and 8 shillings respectively. Below that, we have fixed costs, 96,400,000, 200 million for Y. Then below the fixed cost, we have something there, units sold. And because these are budget, that is now the expected sales. That's the standard sales or budgeted sales. We are given sales in bags. We are given sales in units. Product Y has got 70,000 or 70 million. Product Y has got 30 million. When you add the two, what are you getting? When you add the two, what are you getting? J and 99 others. What are you getting? J and 99 others. So is your question answered? Is your question answered? J is not responding. I want us to move step by step. I can see you have more than one question. So the first part, the origin of 100 million. Have you been able to see how to get it? J tuanzie hapo, yes or no? Have you seen the origin of 100 million? Thank you. Margin of safety in units. Margin of safety in units, we said it is expected sales minus break-even point, full stop. Do we have, now that we have decided to put expected sales in units, which is 100 million, what is our break-even point in units? J and 99 others. What is our break-even point in units? What's our break-even point in units? So when you take 100 million minus 57, what are you getting? Is it anything close to this 43 million? Good. Margin of safety in shillings, it is expected sales minus break-even point. What we are trying to change here is basically shillings and shillings. Can we get expected sales in shillings? As per the budget, they budgeted to sell 70,000 or 70 million units of product M, whose selling price is 6 shillings. They also projected to sell 30,000 or 30 million units of product Y at 12 shillings. Go to your calculator and please write for me these two things. 70 million by 6 plus 6 is the selling price. Expected sales for product M is 70 million. 70 million by 6 plus 30 million by 12. What are you getting? What are you getting? What are you getting? What are you getting? J has not given us the answer. J, confirm whether you are getting the same thing. Thank you. So is your question answered about the origin of 780 million? Thank you. I hope you are now able to understand the origin of this 444,600,000. It is basically the summation of break-even point in shillings that we have here. These two will give you the break-even point in shillings. Really? Which part? Which part should I pardon? Which part? $70 million is the expected sales of product M. We multiply by 6 shillings. What is the expected sales of product Y? 30 million. 30 million by 12. So it is 70 million by 6 plus 30 million by 12. What will we have? What will we have? What will we have? What will we have? Good. So margin of safety as a percentage, what are you getting to 2 decimal places? Rounded off to 2 decimal places, what are you getting here? 43. 2 decimal places. $43 is not 2 decimal places. 43. How about this? Is it giving you the same thing? Is it giving you the same thing? Good. I have a question. If I take margin of safety in unit, then use sales mix to get units for Y and M, then multiply by selling price for each product, will I be correct? Yes. This is your margin of safety in units. If I use 0.7, I'll get what? The share for product M, the share for product Y. Then I multiply by their selling prices. It will give me margin of safety in what? In shillings. It will give me margin of safety in shillings. It will give me this one here. Try that. Try that. Thank you. Good. I want us to introduce something that we dealt with under single product. That is expected profit. If I'm given expected profit, will I be able to get the break-even point? Will I be able to get the break-even point? If I'm given expected profit, or if we interfere with the sales mix ratio, will I be able to get the same thing? So I want to just explain something about this sales mix ratio. That is product M, product Y. So what if in a question you are given 0.7 and 0.3? So the proportion is 0.7 to 0.3. What I will do is very, very simple. How do I get the proportion? I will say 0.7 is to 0.3, right? 0.7 is to 0.3. Of course, I'll talk about 1, then I have something this other side. Now, what I need to do is very simple. For me to convert this to a fraction, I will be talking about 0.7 to 0.3. So add the 2. Add the 2. When you add the 2, it will be over 1. It will be over 1, right? So it means this will be 0.7 over 1, 0.3 over 1. That is it. That's how we deal with it. Or 7 over 10, 3 over 10. What if I'm given now the proportion, that is the ratio is M to Y is 1 is to 1. What will be the proportion? If that is the case, add the 2. When I add the 2, what will I have? 2. So it is 1 over 2, 1 over 2. What if M is to Y is given as 3 is to 5? What will I have? Add these 2. what will it give you? 8. So it is 3/8, 5/8. What are we talking about here? This is now the sales mix ratio. This will be the sales mix ratio. This will be the alpha, right? Alpha, or sales mix ratio, or sales mix ratio. So when I interfere with the sales mix ratio, I'll be getting a different weighted average contribution margin. And what normally happens is, the moment I interfere with the sales mix ratio, then this part will be affected. The moment I interfere with that part, weighted average contribution margin will also be affected. Now, if I am not given the sales mix ratio, I have to look for the expected sales to give me the sales mix ratio. Remember, in this question, the first part of it, you are not given the sales mix ratio, but you are given what we call expected sales or budgeted sales. So by use of budgeted sales, we were able to get the sales mix ratio of 0.7 and 0.3. Good. Now, if I interfere with the sales mix ratio and change it to 1:1, what will be my break-even point in units? Let me see if somebody will be able to do that. If I interfere with the sales mix ratio, if I interfere with alpha, what will be my break-even point in units? If I change now, sales mix ratio is 1:1. So for product M and Y, remember contribution margin is already there. It is not affected. I have 4, I have 8, right? Then my sales mix ratio, right? Sales mix ratio, or alpha, is now 1:1. That is 1/2, 1/2. The same as half, right? 0.5, 0.5. Now, will I be able to get weighted average contribution margin? Half of 4 will give me 2. Half of 8 will give me 4. So what is my summation of weighted average contribution margin? So it will be 2 plus 4. That will give me 6. Total fixed cost is not affected. It is 290 what? 296, 400,000. What is my break-even point in units? Total fixed cost 296, 400,000 divide by 6. What is my break-even point in units? What is my break-even point in units? 49,400,000 bags. 49,400,000 bags. Good. Can I get break-even point in shillings for each product, or even this one here for each product? So for product M, it will be half or 0.5 of 49,400,000 bags. What will we have? Product Y, 0.5 of 49,400. Product M, 24,700. Good. Can we get it in shillings? Can we get what of ratio like 3:2? If it is 3:2, 3:2, 3 plus 2, 5. 3/5, 2/5. That is it. That is it. If it is 10:7, 10:7, 10 plus 7, 17. 10/17, 7/17. Just like that. So please give me break-even point in shillings for product M. what is the break-even point in shillings for product M? Break-even point in shillings for product M. Break-even point in shillings for product M. Good. What do we need to do? Product M, I have 700,000 multiplied by 6. Then product Y, 700,000 multiplied by 12. Product M tuko na ngapi? 296. Yeah, really? 2 million. Well, I know Y will be double of what we have 14. 148, 200,000. So this must be 296. 296, 400. 296, 400,000. Good. Yeah, that is it. If you want for the whole organization, you add the 2, then you are good to go. You add the 2, then you are good to go. Great. So that is when you interfere with the sales mix ratio. When you interfere with the sales mix ratio. When you interfere with the sales mix ratio. So are we together to that point? Maybe before we now look at the question, what do they want to? What do they want? What are you required to do? So Roman 1, the break-even point at current sales mix. The current sales mix, you are to get it from this expected sales, right? Then Roman 2, the break-even point at a proposed sales mix ratio of 1:1. The sales mix ratio is changed to 1:1, right? So 1:1 will give us 1 plus 1, that is 2. So 1/2, 1/2. That gave us 0.5, 0.5. 0.5 by 4 will be 2. 0.5 by 8 will be 4. When I add the 2, I'm getting summation of weighted average contribution margin, which is 6. Total fixed cost, 296,400,000. That's our total fixed cost. So under this arrangement or this proposal, our total fixed costs are not affected. The only thing that is affected is the sales mix ratio. That's why under total fixed cost, I've taken this figure. I've taken this, right? Then Roman 3, current margin of safety. Current margin of safety, of course, we got our margin of safety by use of these original figures, right? And of course, we are all able to see what is there. Then sales units. Sales units required to earn a profit of 299 million at current sales mix ratio. Now, we are trying to interfere with the numerator. And this numerator, we are introducing what we call expected what? Profit. At the current sales mix ratio. What we are dealing with there is basically target profit of 299 million. They are in shillings, right? Shillings. So how do we get break-even point? Remember, they want it in units, right? They want it in units will be total fixed cost plus target profit. Then all of this you divide by summation of weighted average contribution margin. So do we have total fixed cost? Yes, we have 20 what? 296,400,000 plus target profit of 299 million. 299 million. We divide by summation of weighted average contribution margin under current sales mix ratio. Our current sales mix ratio, is 70 million to 30 million. That is 0.7 is to 0.3. So under that sales mix ratio, our summation of weighted average contribution margin was 5.2. So under that, we just have our 5.2. Please go ahead and give me break-even point in units. There's a question, in such a question, when asked margin of safety and the question does not specify in units or in shillings, will either suffice? Yes. So long as you're able to give us the formula there, you will get your full marks. What is your break-even point in units? Yes, I've not interfered with anything. No. 1.1 is the proposed. Can you read additional information number? Read Roman 2. The break-even point at a proposed sales mix ratio of 1 is to 1. The moment they mentioned current, we go back to the default figures that were given to us. Actually, what we have been doing here from the start under this December 2024, that is what we call, let me give you the name. It is called sensitivity analysis. Sensitivity analysis. So under sensitivity analysis, we change one item at a time. Our formula says that break-even point is equal to total fixed cost, right? Plus or divide by summation of weighted average contribution margin. Now, this total fixed cost or numerator, I can interfere with it by introducing what we call target profit. Actually, it should be plus target profit. So originally, we were not having target profit. What if I keep everything constant but introduce target profit? What will happen to my break-even point? That's number one. Number two, what if I keep everything constant, but now the denominator is affected by introducing a different sales mix ratio? What will I have as the break-even point? So changing one item at a time is what we call sensitivity analysis under this topic, right? So the first one, the current is that 0.7 is to 0.3. Proposed is given under Roman number 2. And that proposed sales mix ratio is only affecting Roman 2. Roman 3, your margin of safety should be dependent on the original figures of 70,000 or 70 million for M and 30 million bags for Y. Is that clear to somebody? Is that clear to somebody? So we're getting 114,500,000 bags. So for you to have this target profit of 299 million, you must sell 114,500,000 bags. But can we now distribute these bags to each product? Let's say we want to know the specific quantity of product M to be produced. I'll take the original sales mix ratio of 0.7 by 114,500,000 bags. Then for Y, I'll take 0.3 times 114,500,000 bags. Please go ahead and give me the number of bags that will be produced for M. Number of bags for product M. 150 million. 150 or 80,150,000 bags. Product Y. 34,350,000. 350,000 bags. 350,000 bags. Good. Now, back to the question. Have you been able to see that all questions have been answered? Have you been able to see that we have answered all the questions? Have you been able to see that we have answered all the questions? Good. So at your free time, can you now visit August 2020? Is it August 2024? Question number. Was it tested in August? No, April. You can visit April 2024, question number 3B. This was question number 5B. This was question number 5B. Question number 3 of 2024 December. Question number 3B. Is it part of topic number 8? Is it part of topic number 8, really? That is topic number 4. Question number 3B is topic number 4. Yes, CPA. CPA April 2024 has got a question under multiple products. Question number 3B. Question number 3B. Question number 3B of April 2024 CPA. You'll be able to get everything there. So I want us to introduce limiting factor analysis. Limiting factor analysis. Do you have any under CPA December 2024? I doubt. They normally alternate it with the CVP of single or multiple products. So now that the December sitting, I cannot see limiting factor analysis. Prepare for that concept. Prepare for that. Prepare for that concept. Okay, go ahead, Milton. Go ahead, Milton, as we prepare for question number question number 1B, question number 1C of August 2024. August 2024, question number 1B. That is what we want to do under limiting factor analysis. Then, of course, what we have agreed is April. Another question similar to this concept, April 2020 what? 2024, question number 3. Question number 3B, where we have individual and family, where we have individual and family. One of the sittings in 2017, you will also see something there. One of the sittings in 2019, there's also something about these multiple products. So you have a lot of them, but I want us to now get to limiting factor analysis. Our first question should be August 2024, question number 1B, CPA. CPA. So we'll have the break. We'll have that break. 5 minutes break. When we get back, we move very fast and look at the limiting factor analysis. So our break starts right now. Good. So the question reads, that is ATD, August 2022, question number 2B. So as we do question number 2B, you can clearly see this part, we covered it during our discussion in topic number 4. Highlight 4 causes of labor turnover in an organization. We did that. Why did you leave your previous place of work? Why are you planning to leave your current place of work? So those reasons, please write them down here and you'll be able to get your full marks. Zara Limited produces two products, namely Z and R. The following information relates to the budget for the year ended 30th June 2022. So selling price, variable cost, contribution margin, fixed cost is given here. Then units sold is also given down there. So the sales mix ratio actually is the same as what you are having here. Weighted average contribution margin will be the same for what we are having. But now break-even point will be different because we have a different figure for the total fixed cost. Calculate break-even point for each product. The break-even point for product Z to achieve target profit of 60,000. The margin of safety for product R. The product to produce based on break-even point calculated in B1 above. So my first question is, are we dealing with multiple products or single product here? Are we dealing with multiple products or single products? Is it multiple or single? So that question relates to single product, not multiple, single product, right? The break-even points of each product, the break-even point of product Z to achieve a target profit. Yeah, so that's single product. That is single product. Margin of safety for product R, you deal with them independently. You deal with them independently. Yeah. So that is it. We can now move to CPA, August 2024, question number 1B. CPA. Yes, there are two products, but if you look at the nature of the question down here, the break-even point for product, they are now separating these products, not both, but now they are trying to do what? To separate them. So you deal with each product on its own. You deal with each product on its own. So the product to produce based on the break-even point is very simple. How many units are you going to produce if you are using the same resource? So the one with the lowest quantity will be the one to be produced because you just produce a few of them and you have your break-even point. So that will be the product to be produced. That is what you're going to produce to do what? To maximize your profit with the lowest number of resources committed to it. Great. So let's get to August 2020. Let's get to August 2022. We have very few. 2024. August 2024. August 2024, question number 1B. CPA, August 2024, question number 1B, CPA. August 2024, question number 1B, CPA. August 2024, question number 1B, CPA. Good. So we are told that Medical Limited is a pharmaceutical company which manufactures 3 types of medicines, namely alpha, beta, and zeta, using absorption costing system. The company has 2 grades of labor, that is skilled and semi-skilled labor. The following profit statement relates to the operations of Medical Limited. Selling price per unit, cost per unit is given there, direct material per unit, direct labor cost per unit. Under skilled, we need, it is 80 shillings per hour, but the company spent 80 shillings to produce a unit of alpha. So alpha requires 1 hour for the skilled, beta requires 2 hours, zeta requires 3 hours, right? Then we are having Semi-skilled, it is 60 shillings per hour. The company spent 60 shillings for alpha, that is 1 hour. Beta, 2 hours. Zeta will be 110 divided by 60. That is 1 hour and maybe 3/4 somewhere there. Then fixed overhead cost is given as 100, 100, 100. Then you are instructed to look at note number 1. What is this note number 1 saying? The fixed overhead costs are 1450 million per annum. This 1450 million per annum, we must be having some expected sales per annum to be able to get this total amount. We must be having some expected sales somewhere, right? So if you look at the expected sales of 3,000 units for that is alpha, 5,000 units that is for beta, and 6,500 units that is for zeta. And then you multiply by fixed cost per unit of, and then you multiply by fixed cost per unit, which is 100, it will give us 1450. So at full capacity, all the fixed costs are absorbed, right? Then number 2, variable overheads are absorbed into production at the rate of 100% of skilled labor and 50% of semi-skilled labor. The variable overheads have not been absorbed into the profit statement above, so we must include them up there. There is a maximum of 28,000 skilled labor hours available. Deficit units can be outsourced from a chemist suppliers at the following prices. Required, compute the shortfall in skilled labor hours. Do we have skilled labor hours that is sufficient to fulfill this demand? Or does it mean the company is not able to provide all that to take care of the entire demand? And if that is the case, how will they apportion? How will they know the exact number of units of zeta, beta, and alpha to produce so that they maximize profit from the 28,000 skilled labor hours? From the 28,000 skilled labor hours. So limiting factor analysis is very, very simple. It is the simplest concept under this particular topic. Right, so you're now you'll be adding something here that is limiting factor. Limiting factor analysis. Limiting factor analysis, specifically CPA August 2024, question number 1B. If I'm not wrong, question number 1C. Good. So we've been able to read the question, and we now need to address what is given there. So the first thing we need to deal with is to bring all the items. Before even I look at the limiting factor, what you're going to do here for the first part will apply to any question that relates to the limiting factor analysis. So what are we supposed to do? We are dealing with 3 products. That is alpha, beta, and zeta. There's still enough space on the side. Alpha, beta, zeta. Good. So let's start with the selling price. Selling price for alpha, we are given 595. We are given 870. We are given 1095. Then to that, we need to less all the costs, not just costs, but all the variable costs, right? So our first variable cost is direct material. Our first variable cost is direct material, right? So direct material, we have 115, which we are going to deduct. We have 140. We have 220. Then to that, we have direct labor, right? So just write your direct labor cost. But this direct labor happens to be divided into two. We have skilled, and we have semi-what? Semi-skilled. All of them are variable. All of them are variable. So we have 80, 60, 160, 240, 120, 110. All those are variable costs. Now, I need to consider any other variable cost, not fixed. But of course, the examiner told us to refer to note number 1. Now, look at note number 2. Variable overheads are absorbed into production at the rate of 100% of skilled labor and 50% of semi-skilled, right? So let's talk about variable overheads, right? These variable overheads are absorbed under two categories, right? We are being told that 100% of it relates to the skilled, right? 100% of it relates to the skilled. Then, so the skilled is this one here. It should be 80, 160, 240. Good. Now, we need to consider how these variable overheads will be absorbed. I don't know that is this class or a different class. If you are told we did something to do with absorption, right? And we looked at overhead absorption rate is equal to budgeted overheads divided by budgeted activity level, right? Budgeted overheads divided by budgeted activity level. We are being told that variable overheads under skilled, we need to absorb 100% of it as variable overhead, right? So variable overhead, so overheads absorbed, the variable overheads absorbed into these skilled labor hours will be 100% of it. So 100% of that, 100% of skilled labor cost. Then 50% of semi-skilled, 100% of skilled and 50% of semi-skilled labor cost. Semi-skilled labor cost. So can we get 100% of skilled? 100% of skilled will be 180 plus 50% of semi-skilled, 50% of 60 will be 30. So our overheads, variable overheads for alpha will be 80 plus 30, 110. Variable overheads absorbed for product beta, 100% of skill, that is 160 plus 50% of semi-skilled, that is 60. So 160 plus 60, that will be 200 and what? And 20. Then 100% of skilled to 40 plus 50% of semi-skilled 55. So 240 plus 55, is it 295? Is it 295? Great. Any other variable cost? All variable costs must be grouped together. All variable costs must be grouped together. Now, when I take selling price minus all the variable cost, What I will be getting here is called contribution. It's called contribution per unit. So can we get that contribution per unit? It is selling price minus all the variable costs. Minus all the variable costs. Minus all the variable cost. So give me for any of the three products. Ukipata the first one, you give us, someone can start from zeta and post the answer there. So I'm told 230 relates to alpha, right? 230 relates to alpha. How about beta? Beta tuko na ngapi? Beta tuko na ngapi? It is also 230, okay. How about zeta? Zeta tuko na ngapi? Pia ni 230. So does it mean we have 230 all through? Does it mean we have 230 all through? Good. So it is not going to bring out clearly what I wanted to explain from the word go. But assume you are to rank these products based on profitability. Which one will you go for? Beta is 450. All are 230. Mwingine anasema beta ni 450. So does it mean if I take 870 minus 140 minus 160 minus 120 minus 220, I should be having 450? Grace, confirm that. Should it be 450 ama? Mtu anapata 710. Anyway, let's leave it at 230. Good. So if you are to select the most profitable product, which one will you go for? Which one will you go for? So at this point, you cannot tell what you'll be going for. But I want you to do this so that you know the product that you'll be going for. The product that you'll be going for. Remember, we have limited resource, and this limited resource is available skilled labor hours. We only have 28. Available skilled labor hours, we only have 28,000. If you are to fulfill this demand of the 3,000 units, the 3,000 units for alpha, which requires how many hours? 1 hour plus the 5,000 units of beta, which requires 2 hours, 1 hour, plus the 6,500 units of zeta, which requires 3 hours. What will be the total labor hours? What will be the total skilled labor hours? If you are to fulfill this demand, this is the maximum demand. So 3,000, this should be 3,000, sorry for that, 3,000 units of alpha by 1 hour, plus 5,000 units by 2 hours, plus 6,500 by 3 hours. What will be the total labor hours? You will be in need of what? 32,500 hours. So if what the company can purchase, or I mean pay for, is 28,000 hours, and for you to fulfill what is demanded, you need 32,500 hours. Do we have surplus or deficit? Do we have surplus or deficit? Do we have surplus or deficit? We have deficit, right? We have deficit of how many hours? We have deficit of how many hours? 4,500. 4,500 hours. So another name of deficit is called shortfall. Another name of deficit is called shortfall. Have we answered any question there? Have we answered any question? Have we answered any question? So have you seen how to answer the first part of the question? It does not rely on this section, right? It only relies on available limited resource and maximum demand. Hizo hours zimetoka wapi? Tumeambiwa that is the budgeted cost of producing a unit of each product. Look at the skilled labor cost. That is alpha, zeta, beta and zeta. For us to produce a unit of alpha, the company spent 80 shillings, 160, 240. Do we have labor cost per hour? Do we have labor cost per hour? If yes, please give me labor cost per skilled labor hour. What is the labor cost per skilled labor hour? So if labor cost per hour is 80 shillings and you've incurred 80 shillings, how many labor hours are we talking about here? How many labor hours are we talking about here? If the rate is 80 shillings per hour, that will be 1 hour. If you have spent 160 shillings and each hour is 80 shillings, how many hours are we talking about here? If we have utilized 240 shillings and each hour is going for 80 shillings, how many hours have you utilized? Have we answered your question? Is your question taken care of? Is your question taken care of? Great. That is it. Now, for us to be able to get or to rank these products based on profitability, I must consider now limiting factor per unit. Limiting factor. So our limiting factor here is skilled hours, skilled labor hours. Alpha requires 1 hour, beta requires 2 hours, zeta requires 3 hours. So please use this to be able to give us limiting or contribution. Give us now benefit, contribution per limiting factor. Contribution per limiting factor, you can take contribution divide by this. It will give us 230. Itakuwa ngapi? Will it be 115? Na itakuwa ngapi? 230 divided by 3. 230 divided by 3. 230 divided by 3 ni ngapi? $230 divided by 3 tunapata ngapi? 76.67. Right? So if I were to use 1 hour to produce alpha, I'll be getting 230 as the benefit. If I use the same hour to produce beta, I'll be getting 115. The same 1 hour to produce zeta, I'll be having 70 what? 6.67. So which one is the most profitable at this point? Which one is the most profitable? Which one is the most profitable out of the 3? The one with the highest benefit per limited resource. So alpha will be number 1, followed by beta, followed by zeta. So if you are to do production, you must start with the most profitable product. We must start with the most profitable product. Just pause it at this particular point. When we meet on Friday, we'll be able to finalize this and look at another question. Between today and Friday, just go to the limiting factor analysis question and handle 1 question. Just go through that video, listen to it, follow through, and wait for us on Friday. You'll be able to enjoy that lesson. Should we rank only? Yes, that is the only limited resource. That's the only limited. It is the only limited resource. What if you are told that semi-skilled labor hours were also limited? If we have 2 limited resources, then we use what we call linear. We use what we call linear programming. If we have 2 limited resources, then we use what we call linear programming, but that is not covered under management accounting or in any management accounting unit under CPA. It is not there. So option of dropping or continuing is not under limiting factor analysis. It is under topic number 8, but not this concept. But not that concept. Is it clear? Is it clear? Is it clear? Great. Thanks for your time. Have a blessed night, and let's meet